I would like to discuss how to use mutual funds for effective long-term retirement planning. How could you incorporate mutual fund investing in your long-term retirement planning? So, in this concept, we consider uh, point number one is diversify across asset classes. Diversify across asset classes. And so for long-term growth, it's important to diversify your portfolio by investing in a mix of equity, bonds, and balanced mutual funds. And you could consider equity funds. You may equally incorporate bond funds as well as target dated funds. Equity funds essentially invest in the stock market. Bond funds, essentially they invest in different kind of bonds. And in the case of target dated funds, they actually automatically adjust the asset allocation uh, as you approach retirement, gradually becoming more conservative. It's applicable to I'm a civil servant, so it's applicable to our pension, uh, our pension accounts, our pension fund account. You discover that as you advance in age, your administrator will change your should I say class or what? You have class one, class two, three, four, something of that nature. So as you're advancing in age, they will be graduated to an upper class, and the asset mix differs from classes to class, from one class to the other, depending on your age. Because as you grow older, you get the more exposed to a kind of conservative asset mix. That's a typical example of target date funds. Number two is focus on low cost funds. Focus on low cost funds. So minimize the impact of management fees by choosing funds with low expense ratios. Over the long term, high fees can significantly erode your returns, the returns on your retirement savings. So take into consideration low cost funds. And you may also consider index funds. These funds are passively managed and typically track a given index, and they have low fees while offering a broad exposure to stocks in a given index or to securities in a particular index. Number three is reinvest dividends. You reinvest dividends. So reinvesting dividends can compound your returns over time. And this approach allows you to buy more shares without additional cost. You could buy shares, with without paying fees. You don't pay commission. It doesn't really attract cost in some cases, or in most cases. These would boost your potential returns at the end of the day, and can equally enhance growth in your portfolio. So many mutual funds offers what is called the dividend reinvestment plans, which automatically reinvest your dividends into more shares of the fund. As your dividends comes out, the dividends are reinvested for you automatically. So by so doing, you have much. You are able to buy additional shares, which will in turn equally boost your overall level of dividends whenever it is declared. Number four is use dollar cost averaging. Dollar cost averaging here, it involves investing a fixed amount at regular intervals, regardless of the market condition, regardless of the prices of stocks in the market. You simply just have, you invest a fixed amount at regularly. It might be quarterly, biannually, or yearly, but you simply invest a fixed amount, in the market. This strategy reduces the impact of short-term market volatility and lowers the average cost of your investment over time. So dollar cost averaging works well for long-term retirement savings And as it helps, you avoid trying to time the market. You don't time the market because of everything in dollar cost averaging is somewhat automated, and so there's no human interference at all. Number five is consider tax advantaged accounts. You use tax deferred accounts like your 401k as well as your IRS to invest in mutual funds. And these accounts allow your investment to grow without paying taxes on gains until when you eventually withdraw your investments. It helps you avoid trying to time. Um, it's kind of it's ideal for those who are retired or those who are approaching retirement. Actually, and you don't get to withdraw until you don't get to pay tax until when you eventually withdraw the fund. Number number six is you stay consistent and avoid emotional decision. Stay consistent and avoid emotional decisions. You stick to your long-term strategy and avoid making decisions based on emotion or based on short-term market movements. Much as possible, have a long-term objective when it comes to investing so that the noise in the market will not compel you or influence you to panic and make decisions that are not really based on logic or reason. So as you approach as you approach retirement, the power of mutual funds lies in the ability to grow over time. So consistent long-term investing is key to achieving your retirement goals. You have to be consistent. You have to take a long-term view so as to be able to maximize your returns at retirement. Number seven is uh, monitor and rebalance your portfolio. Please subscribe to this channel and like this video if you've not done that. So you monitor and rebalance your portfolio. In this case, you need to regularly review your portfolio and to make sure that the investment there aligns with your long-term objectives, align with your investment goals, and whenever necessary, you could make adjustments. You buy some here, you sell some there, you increase the quantity of some other asset classes there, as the case may be. So you adjust your allocation to maintain your desired level of risk as well as the desired return you want to obtain. Number eight is use target date funds for hands-off management. Target date funds. So target date funds are ideal for investors who prefer a hands-off approach. You don't want to get personally involved in the investment process. And so these funds automatically adjust their asset allocation based on the target retirement year because you becoming, usually as you grow older, the fund will put you in a class that is invested in conservative, securities. So they become more conservative as you approach retirement. At age 40, it's a different class. At age 50, is a different class. At age 60, you're approaching retirement, they will put you in a class where the investment there is a bit conservative. But you have, like in my own case, I had an option actually. So I had to I had to go back to a lower class where they had riskier assets because I'm quite comfortable with the risk. Because generally I will have a better returns than if I am placed in the actual class I belong as per my age. So I don't want to be I want to be in an earlier class where they invest in riskier assets with greater return potentials, and that is what I instructed my pension fund administrator to do for me. And so this strategy helps ensure you are investing in the right balance of stocks and bonds as a retirement date approaches. It's a good idea actually, but I'm not comfortable with it. since I have you know, some level of I think I have a higher risk appetite, so I had to revert back to an asset mix with more of stocks than bonds. So mutual funds are powerful tools for long-term retirement planning due to their diversification, professional management, and ease of use. By diversifying your investments, focusing on low-cost options, and consistently contributing over time, you can build a solid retirement portfolio that grows with you. That grows to be able to meet your preference. That grows, you know, at the pace you want, so as to be able to secure your retirement at the end of the day. You're able to meet up with your financial goals at the end of it all. So it's a very interesting kind of thing. Particularly if you want to retire, it's necessary to invest in a mutual fund. You know, and if your company has a 401k plan, they will do it automatically for you. So that's you contribute and your employer will match your contribution and invest it in that in a tax advantage account for you. That will help you to guarantee a comfortable retirement